Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. ETFs are growing fast, and sector-specific ones let you zero in on industries you believe in. These funds bundle stocks from a single sector, like healthcare, XLV, or retail, XLY, giving you targeted exposure without picking individual companies. They're a simple way to diversify while focusing on areas with potential. If you've ever wanted to invest in a booming industry without the guesswork of stock selection, these ETFs might be your answer. Whether it's tech, energy, or consumer goods, there's likely a fund that matches your strategy. Let's look at how they work and why they're gaining traction. Understanding sector-specific ETFs. Sector-specific ETFs bundle stocks from a single industry, like tech, healthcare, or energy, into one tradable fund. Unlike broad market ETFs, such as SPY or VTI, which spread investments across multiple sectors, these ETFs focus narrowly, letting you bet on specific industries without buying individual stocks. They offer the same ease of trading as other ETFs, but with laser-focused exposure. 3 key traits set them apart. Sector allocation. They hold stocks from just one sector, like XLOC for tech or XLE for energy. Liquidity. Most trade frequently, keeping bid-ask spreads tight. Expense ratios. Typically low, often under 0.20%, cheaper than actively managed sector mutual funds. Why add them to your portfolio? They're tools for tactical moves, like overweighting healthcare ahead of regulatory changes or underweighting retail during economic downturns. Used wisely, they sharpen your strategy without the hassle of stock picking. How sector-specific ETFs work. These ETFs track sector-specific indices, like the S&P 500's healthcare or financial segments. Here's the breakdown. Index tracking. The ETF mimics a predefined index, e.g., XLV follows the Healthcare Select Sector Index. The fund manager buys all or representative sample of the index's stocks. Rebalancing. Indices rebalance periodically, often quarterly. The ETF adjusts its holdings to match, ensuring it stays aligned with the sector's performance. Dividends. Most sector ETFs distribute dividends from underlying stocks quarterly, though some reinvest them automatically. For example, XLY, Consumer Discretionary ETF, holds Amazon, Home Depot, and Tesla. If Tesla's weight in the index drops due to a stock split, the ETF sells shares to match the new proportion. No guesswork, just mechanical, rules-based adjustments. Benefits of investing in sector-specific ETFs. Want to capitalize on a hot sector or hedge against weakness elsewhere? These ETFs deliver targeted exposure. Back a single industry, e.g., clean energy with ICLN, without analyzing dozens of stocks. Lower costs. Expense ratios average 0.10 per cent 0.30%, undercutting actively managed sector mutual funds. Flexibility. Trade them like stocks, buy or sell anytime during market hours, unlike mutual funds that price once a day. Real-world example. During the pandemic, XLV, healthcare ETF, surged as drug makers raced for vaccines. Investors gained broad exposure to the sector's rally without betting on a single company. Similarly, XLF, financials ETF, climbs when interest rates rise, a trend easier to ride via ETF than picking individual banks. Short-term traders use them for quick sector rotates. Long-term investors add them to balance core holdings. Either way, they're a scalpel in a toolkit often full of hammers. Popular sector-specific ETFs and their performance. Sector-specific ETFs like XLV and XLY let you invest in entire industries with a single trade. These funds are straightforward, cost-effective, and packed with top-performing stocks. Below, we break down 2 of the biggest players: healthcare, XLV, and consumer discretionary, XLY. Healthcare Sector ETF, XLV. XLV tracks the Healthcare Select Sector Index, giving investors exposure to pharmaceuticals, biotech, and healthcare providers. It's a go-to for those bullish on medical innovation or defensive positioning. Top holdings. United Health Group, 9.5%. Johnson & Johnson, 8.2%. Eli Lilly, 7.1%. Performance and trends. Over the past decade, XLV has delivered steady growth, with an average annual return of around 11%. It outperforms during market downturns, thanks to healthcare's recession-resistant nature. Recent momentum comes from weight loss drugs and aging populations boosting demand. Low expense ratio, 0.09%, keeps costs minimal. Investors choose XLV for stability and long-term demographic tailwinds. It's less volatile than tech but grows reliably. Consumer Discretionary Sector ETF, XLY. XLY tracks the Consumer Discretionary Select Sector Index, covering retail, entertainment, and luxury goods. It's ideal for betting on consumer spending trends. Top holdings. Amazon, 22.6%. Tesla, 14.3%. Home Depot, 7.1%. Performance and trends. XLY thrives in economic expansions but drops during recessions. Over the last 5 years, it returned an average of 12% annually, though with higher volatility than XLV. Recent performance hinges on Amazon's e-commerce dominance and Tesla's EV growth. Expense ratio is competitive at 0.09%. This ETF suits investors confident in consumer resilience. It's a cyclical play, strong when wallets are open, shaky when budgets tighten. Both funds offer simplicity and sector-specific exposure. Whether you prefer healthcare's steadiness or consumer discretionary's growth potential, ETFs like XLV and XLY streamline the process. Thanks for watching Part 1. Stay tuned for Part 2. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.